So I want to get more on these latest developments now from Pimco's European Head of Credit Portfolio Management. Luke Spajic has more than 15 years investment experience. He's previously worked as a trader at Goldman Sachs as well as JP Morgan subsidiary Highbridge Capital. Pleased to say he joins me now. Thank you so much for speaking to us. Welcome to the Pulse. So I want to ask you about Pimco's latest report, because it talks about the European peripheral landscape undergoing exceptional change, transforming the face of European credit markets. Just talk to me a little bit about what we've seen in the credit markets over the past year or so, and what are the implications of that for the future? Sure.
Well, thanks again. Well, clearly we've had a major differentiation between the likes of Greece, Ireland and Portugal. And we've kind of seen a bifurcation with Spain and Italy, again, peripheral economies, but being slightly away from the danger zone. Even within these economies and outside these economies, we've seen huge differentiation in credit performance across banking sectors, across autos, across utilities, across telco companies. So the upshot of our report is that you've got to look at the sovereign very carefully, take a credit view rather than a rate view, and then figure out which corporates you want to own that might get contaminated. Banks are obvious, but other corporates are suffering too. Which ones are suffering the most? Sorry, go on. Well, rather than going through single names, I think the sectors are pretty important. I mean, you can point to utility companies in the likes of Portugal. You can look at the banks in Greece, and you can see the best example is probably the Spanish banking system itself, although we don't necessarily think that Spain is going to go the way of Greece in terms of spread risk, but we do think their banking system needs a hell of a lot of work, and the cajas in particular. So how are investors supposed to deal with that then? Well, there's two things. Number one, you've got to be value focused. Don't go out and buy Spanish banks when the sovereign trades at 270, 280 over, and the banks trading well inside of that. I think that's one of the key things. Focus on the sovereign rather than the banks. And in terms of looking at things like the utility companies, look at the way in which credit erosion is going to work over time. Can they really increase prices in line with inflation? I mean, we've seen in Spain, for instance, utility companies have not been able to raise prices. So you know what? Underweight those sectors and don't rush back. Don't get mesmerized too quickly by wider spreads there. I mean, I guess there seems to be a real lack of visibility right now when you look at some of the changes, the challenges facing Europe. Can you say with certainty that Spain and Italy, that the worst case scenario has effectively eased for those countries? No, not with certainty, but I think on the balance of probabilities and where they end up on a 2-3 year view, it's increasingly unlikely that Spain will see the same kind of debt dynamics that the likes of Ireland and Greece have seen. I mean, we're not talking about debt to GDP going north of 100, 120, 150%. It may be settling in around about the 80% level. But the thing is, that destination is one thing, but the journey can be very, very bumpy and very rough. And I think you need to look at this thing with respect to value over time, and given the opportunities that come along when new issues pop up, or when you get a chance to get out of trades that you don't really want at tight levels. Talk to me a little bit about Greece. A great deal of uncertainty about the distinction between reprofiling, restructuring. What are you focusing on? What do investors need to pay the most attention to right now? Well, I think you need to really split the world into two camps. Camp number one doesn't really think anything is going to happen or should really happen with Greek debt. And one of the institutions like the European Central Bank certainly wouldn't want to see any kind of change. On the other hand, you have a lot of investors that are forecasting all kinds of tail risk scenarios. Now, whether it be reprofiling, whether it be a restructuring or default, ultimately, before you get to a really, really bad outcome, I think you're going to get some kind of voluntary process in place first. And that means, it doesn't necessarily trigger CDS, it doesn't necessarily get people into deep trouble straight away, but there'll be this kind of soft, coercive suggestion that that should be extended. And I think that might be the first point. But even before that, 20th of June, it's quite a big meeting coming up with regard to more money coming from the IMF and the EU. And in fact, the Greeks are earmarking all the things they need to do to get to that date. So you're saying that the key distinction to make is to see whether it is voluntary or involuntary. That will make a difference to the consequences for other euro area bond markets? Yes, it will be. And also that the timing is critical. Now, if we had an instantaneous problem, in other words, if this were brought forward to within the next few days, for instance, no one's ready for that kind of event. I think that the longer this drags out, and what we call kicking the can down the road, the more more investors have in terms of reserving against this kind of problem and trying to immunize against the problems of contagion. And I think that policymakers in Europe, central bank in particular, they're all trying to buy time and ensure that banks in Europe get their capital ratios, ready for some kind of left tail hit.
And if I could ask you a very specific question with in regards to the so-called CoCo's contingent convertible bonds, and actually related to the bank's subject that you were speaking about there. I mean, are they suitable candidates for inclusion in a mainstream institutional investment bank credit fund, or are they suitable for specialist funds like yours?
Well, I can't comment on any specific funds, and I won't cheerlead the sector. In other words, all contingent capital. I think what I will say is that there are certain securities that have been issued over the last year or so that look remarkably interesting, especially when they have very, very low trigger levels to be turned into equity, which look quite remote given where we are today. So I think very, very strong stock selection means that you can get a lot of value in these securities. Should they be in mainstream accounts? We believe they should be, because they're very different to a lot of other bank capital securities. They're very different to a lot of other instruments that trade in the credit universe, but they offer, north of high yield kind of yields. And I think they're attractive because they'll allow investors to diversify their book and get a lot of coupon income. And that coupon over a 4 or 5 year period can be 40 or 50% in terms of total return.
Really interesting to get your thoughts on that. Thank you so much. Do join us again, Luke Spajic from Pimco Europe.
Thank you.